Be Wealthy and Smart, episode 494.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the 7 ways to get $1 million into your 401k plan. And you're going to learn how to maximize your investments and what to do exactly so that you can get $1 million in your 401k plan if you don't have that already. I was reading an article that talked about how many people have $1 million in their retirement plan. Do you have any idea? Well, in 2017, about 150,000 people have a 401k that has $1 million or more in it. And 152,000 have an IRA with $1 million or more in it. So congratulations if that's you. If that depresses you, well then listen on and we'll talk about how you can get $1 million in your 401k plan. Because I do believe that it's something that is achievable for everybody. And there are some secrets to what you can do to help get this happening easier for you and help it be a little bit more certain for you. So we're going to talk about how you can reach that in your retirement plan. But you might be saying, Linda, I don't have a retirement plan. I don't have one that's offered through my work or, whatever your work situation is, maybe you don't have a retirement plan or maybe you don't have access to a retirement plan. And that's okay because you still have access to an IRA even if you don't have a 401k plan at work. And there are some different regulations about how much you can put in and so on. And for the purposes of this podcast, we're not going to be going through all of the ins and outs of contribution limits and the tax angles and all of that, because I've done prior podcasts about that. So for this podcast, we're going to talk about the investment portion and just talk about the accumulation and how to get you to $1 million. So it's going to make it a lot more simple. It's going to make it a clearer conversation, and we're not going to get bogged down in all the boring details of taxes and this and that and how much you earn and how much you don't earn and what's deductible and what's not, because I think a lot of people just get tuned out and bored with some of those details. You might not, but some people do. So what we're going to talk about is really the nuts and bolts of what gets people $1 million in their retirement plan. That's what you need to know. That's really what the important part of this whole dialogue is about. So here we go on the 7 steps. Number 1, the most important thing you can do to make getting $1 million easier for you is to start as soon as possible. It's so important for you to start, even if you can't afford very much, even if you're doing $50 a month. Whatever you can put aside, it's so important to start as soon as possible. And that's because compounding is what's going to grow a lot of this money for you. It's not the actual contributions that you're going to make. It's a lot of it is the time that the compounding has to work for you and to benefit you and to grow your money for you. So one of the most important things is to start as soon as possible. If you're just out of college and you're getting your first job, this is the time to start with your 401k. Even if it feels like you're not making that much money and it's hard to make ends meet, you still want to put just even a small amount away into your 401k. Whatever you can do, you want to put the most that you can do, of course. But even if you feel that you can't afford to contribute, I want you to just stretch and put a little bit aside, even if you feel like you can't afford to. I really want you to start early. It's so important. Step number 2, if you can, invest the maximum that you can in your 401k, or if you can't invest the maximum, at least try to get the maximum that you can invest to get your company's match, if they do offer a match. And I realize many companies nowadays don't even offer matches, and that's getting rarer and rarer as time goes on. But if your company does offer, for example, a 6% match, they'll give you 6% free money. That's free money. That is awesome. It's also not going to be taxable right now until you take the money out years from now. So it's a tremendous thing to get free money from your company, and tremendous that it allows to grow and compound over time without having to pay tax. So it's very important that you invest the maximum that you can. Now, in a 401k or a 403b, if you're a teacher or work for a hospital, the maximum is the same, $18,500 per year. If you don't have a 401k or 403b where you work, you can open an IRA. Of course, there's a traditional IRA and Roth IRA, and that's going to depend on how much money you make. If you make, quote, too much money to invest in a Roth IRA, then you're not going to be allowed to open a Roth IRA, and you can open up a traditional IRA. But without going into all of that, and again, that's getting more into the tax side, let's just talk about if you knew that you could invest in an IRA, the maximum would be $5,500 per year. Number 3, if you're over age 50, then you have an additional amount called the catch-up provision that you can add. So on a 401k or 403b, you can add an additional $6,000 a year for a maximum contribution of $24,500. And for an IRA, you can add an additional $1,000 per year if you're over age 50 for a total contribution of $6,500. Number 4, and here's where we're really getting into the meat of this, because this is what a lot of people miss. Yes, it's important to get the maximum in that you can. Yes, it's important that you start as early as possible. But number 4, it's also important that you invest in stocks. It's very important that you invest in stocks, because stocks over the long term have the highest average annual rate of return. And that means you're going to be compounding your money. You're going to be having it work the hardest for you that you possibly can. Year in, year out, throughout a long time, stocks have returned on average about a 10% annual return. So if you want to get that 10% average annual return, that means that you've got to be invested in stocks. That means things like the S&P 500, the 500 largest companies in the US would be, for example, an ETF that you could invest in. Very low fees, and certainly 500 large companies that you could invest in. I always talk about asset allocation and how to diversify your portfolio with asset allocation. If you're not familiar with that, you want to go back and listen to some of my asset allocation podcasts. But I always talk about having some in large cap or large companies, some in medium-sized companies, some in smaller companies, some in international emerging markets, maybe real estate. These are the kinds of things that you want to have some of each asset class in your portfolio. And the company that you're invested with can tell you what category your funds are in. And then you can just plug them into an asset allocation model. So it's important to have diversification, and all of those things are equity style investments. They're all stocks. So the lower returns come in things that are bonds. Those are less risky, but they also have a lower average annual return. Now, if you're looking in the rearview mirror, and we've talked about this many times, bonds can look very attractive for the rate of return that they've had over the past 30 years, but that can't happen again because they were coming down from double-digit interest rates to almost zero interest rates. And as interest rates decline, it makes the value of the bonds rise. Now we're coming off of an almost zero interest rate floor, and interest rates are a little above that, but not much, and they're going to be rising in the future, which means the value of bonds are going to be declining as interest rates go up. So we're in the opposite situation of what we've been in. So you can't use those long-term track records for bonds and assume that you're going to get the same things going forward. A lot of them have very attractive double-digit returns, and you look at it and you think, maybe, wow, I'd like to have these returns in this bond portfolio. But again, it's impossible because of the way bonds work and the way interest rates are going and the fact that we have already bottomed in interest rates and now we're moving up in interest rates. So the important thing is to have most of your portfolio be invested in stocks. And here's an example of how investing in stocks can be very lucrative for you. So if you are a younger person and you have 35 years to accumulate your 401k, let's say, and you're interested in getting $1 million in that 401k, it would take you roughly $3,000 per year, every year for 35 years at a 10% rate of return to earn just a little under $1 million. If you waited 10 years and invested with 25 years until retirement, and still could invest at 10%, our average stock market return, instead of $3,000, it would take you $8,000 to get to just under $1 million in your portfolio, in your 401k. So from $3,000 to $8,000 a year if you wait 10 years. That's why it's important to start earlier. And then if you wait until you only have 15 years until retirement, to get to $1 million at 10%, it's going to take you 3 times that, or $24,000 per year for 15 years to get a little under $1 million in your portfolio. Do you see why it's so important to start early? It's a lot easier. You can fund it with less money. Given the same rate of return, again, it costs you a lot less, and you can accumulate longer and get that compounding working in your favor. So you definitely want to start early, be in stocks, and put in the maximum amounts that you can. Number 5, I don't advise that you use what's called a target fund. There are retirement plans out there that have what's called a target fund, and that's where they figure out the percentage of investments for you, and they put you in a percentage of stocks and bonds. Well, I don't like how a lot of those are distributed. Some of them they're very heavy in the bond side. And as I've explained, that is not my favorite place to invest. If you want to maximize your rates of return, you're going to have to be in stocks. So I don't recommend using target funds. I recommend choosing your own asset allocation and plugging it in to, large cap, mid cap, small cap, international, emerging markets, REITs, etc., all equities that you can invest in. Of course, if you're close to retirement, you want to pull back on some of your all equity investments, but that's a different conversation. We're talking about maximizing your rate of return in your 401k right now, or in your IRA. So we're talking about maximizing that rate of return, thinking that you have a long term to invest. And again, if you're close to investment, then it's time to get a little bit more conservative and to reduce the amounts that you have in stocks. But if you're a younger person and you're saving for the long term, you want to have most of your money in stocks. Number 6, you want to get comfortable with risk. I realize that investing in stocks means that you're going to have fluctuation in your account. It means that there's going to come times when the stock market drops by 20%, 30%. That happens every few years. And listen to my podcasts about what to do when we have those kinds of pullbacks in the market. But typically, if you're investing for the long term, there's absolutely nothing to do. Just stay put, hang in there, don't panic, don't sell, and allow your money to stay in the market and compound. So get comfortable with risk, realize that we're going to have those 20 to 30% pullbacks, and you want to take advantage of those if you can, because stocks are on sale and you can buy them cheaper. But the good news is, if you're investing in your 401k or an IRA on a monthly basis, you're already doing what's called dollar cost averaging, which means you're buying every month. And so when you have those dips, you're going to be buying sometimes when the market's down and sometimes when the market's up. And over time, on average, you'll have a better price by being able to buy sometimes when the market's down. So it's okay. You're going to be taking advantage of that already because you're investing on a monthly basis in this kind of a plan. And the 7th tip is to stay the course. As I said, if we have dramatic pullbacks or we have sharp corrections in the market, you still want to hang in there. And you want to keep your focus on staying invested, staying in equities, and staying in for the long term. That, again, is going to be the easiest way for you to get to your $1 million in your retirement plan. I know you can do this. These are all very doable things that anyone can do. They're not things that require a lot of work. They're not things that require a lot of knowledge. They're not things that require necessarily even a lot of money if you start early. So follow these tips and it is doable for you to get your $1 million in your retirement plan. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.